morning, everyone. It's a pleasure to introduce Carol O'Rourke. Carol O'Rourke is a certified financial planning professional with extensive experience in personal finance, ranging from budget, managing credit, and reducing debts to building retirement savings and investing. A graduate of NYU Stern School of Business, she obtained her MBA. She worked on Wall Street for 25 years and later ran a nonprofit presenting financial literacy classes throughout New York City. Now, without further ado, I'd like to present to everyone Carol O'Rourke.
Thank you, Anthony, and thank you to the association for inviting me back. I think this is my third, maybe my fourth time. So while it's National Library Week, and happy week to everybody, it's also Financial Planning Month. So it's a good time to kind of take a step back and look at your finances. So the agenda is basically, what is credit? I assume you know something about that. I get mostly questions about credit reports and scores, but also how do you manage and reduce debt? And finally, I'm going to talk a little bit about what if you have a debt collector calling you. And this happens if you have student loans or credit card debt that's over 6 months old. So I'm going to address all of these questions. I put this slide in early on because I don't want to forget about these new developments that you may not be aware of. When you're shopping online right now, you may see something saying you can make your payments in 4 equal amounts, buy now, pay later. For some of us, you may remember layaway plans where you would choose something at a store. If it was $25, you could pay it off in 3 or 4 payments, but you didn't get the item until you paid in full. It's different now. Now you have buy now, pay later, and it's mostly for online purchases. And frankly, the target market is young people who do most of their shopping online. Buy now, pay later is a way for you to have credit without actually having a credit card. You divide the payments up and you get the item right away, and they're just trusting you to pay it. I've got some more comments to talk about, but there are several firms, and this is a really growing trend right now. So I'm going to discuss that a little bit later, but I want you to be aware of it. Another recent development, and this happened a couple of months ago, there was like a real trend. Several banks are now dropping their overdraft fees, meaning if you use a debit card instead of a credit card and you overdraft your account, you would often be charged $35 or $40 every time you overdrafted the account. So the example everybody used was that $4 cup of coffee could cost you $39 because you overdrafted. Wells Fargo actually made over $1 billion in overdraft fees last year. And the other banks were behind, but not that far behind. What happened is the government is starting to look at this. This was a real revenue raiser for banks. And it really took advantage of people who probably could least afford the overdraft fees. They didn't have enough in their bank account. They had to watch their budgets. And all of a sudden, if they didn't pay attention, they were getting hit with these $35 or $40 fees once or more a month. The third recent development is that some credit card issuers are now charging more to merchants. And you may think this doesn't affect you directly, but it does. Many stores now will charge extra if you use a credit card. And they're saying, well, the credit card issuer, MasterCard, is charging me 4% every time I charge something on MasterCard. And so if you're using a credit card, I'm passing that charge on to you. This fee is going up. And so you may end up paying 5 or 6% more when you buy something using a credit card versus using cash. This trend started with gas stations where they would charge more if you used a credit card. But now it's really gone to, the place where I buy fish actually charges 4% more if I use a credit card. And it's not always costing them 4%. So the merchant is making a little bit of money on this as well. It's just something to be aware of. So when we're talking about inflation at almost 8%, this may be one of the reasons that all of these charges are being added. Okay, so what is credit? Credit basically is borrowing, you know that. But there are 2 kinds of credit. One is secured and one is unsecured. You may think this is basic, but this is the whole reason why when you have a secured loan where you take out a mortgage and it's secured by the home, or you have a car loan and it's secured by the car, if you don't pay, the bank has some kind of recourse to take your house, reclaim your car. And so they get something back rather than lose all of the money that they loaned you. An unsecured debt is how credit cards work. There's no collateral, so there's nothing that the bank can take back, only your promise to repay. The difference between secured and unsecured is you can get a secured mortgage for 4%, but a credit card, they might charge you 19% because they are taking a very large risk. Because if you don't pay for that sweater or you don't pay for that meal, there's no way that they can reclaim anything. They're losing money. So the difference between secured and unsecured is the reason there's such a wide range of costs for credit. So the question is, are you a good risk? And this is when we'll talk about scores and reports. You may have seen this slide before, but credit cards are not bad in and of themselves. They're convenient. They're safer than carrying cash. They have more consumer protections. If your credit card number is stolen, even if you still have the card in your possession, you have recourse, and it's the company that has to pay if there are charges on that card that you didn't make. With a debit card, you don't have that same consumer protection. You really have to fight and prove that these weren't your charges. This is one of the reasons why when you might get a call from your credit card company saying, there was recently a charge for, $650 at Best Buy, is this you? They have the chance to shut it down, because if it is not you, it's the credit card company that's responsible for covering that loss, not you. Legally, there's a $50 liability, but most companies don't even charge that. So there are some advantages to using a credit card. You can buy large purchases. It affects your credit rating, which allows you to get maybe an apartment or buy insurance. It's just convenient, and it improves your credit report and score. The bad part, of course, is debt can build up quickly. If you just lose 1 month where you say, well, I'm not going to pay this month because I have some other bills to pay, that builds up quickly. And a lot of credit card companies, including American Express, charge daily. So the interest compounds daily. So it grows a little bit more quickly than if only compounded monthly. High interest rates, I talked about. I'll show you some average interest rates. And of course, you can have a negative credit report if your payments are late. As long as you pay on time and you pay at least the minimum, you can maintain a good credit report. The easiest way to explain interest is think of it as rent that's on the money that you borrow. So as long as you have a mortgage, you're paying not just the money that you borrowed, but you're paying the interest. And so it's like the way you're renting this money. Once you pay it down, no more charges. Same thing with a credit card. As long as you use the money, you're paying interest to rent that money. And just about all credit cards, if you pay them off immediately at the end of the month, there's no charge. So that's really the ideal way to use a credit card. So here's the imbalance. Average credit card interest rate right now is over 16%. Instant approval, meaning you go to the Gap and they say, do you want to save 10% today? We'll give you a credit card if you open an account, and we'll give you a 10% discount. It's almost 20% interest. And these instant approvals, they don't give you a large credit limit. They may only give you $200 or $300, and you can easily spend that or go over it. And all of a sudden you're into a world where you're paying 20% to borrow this money. With one exception, I would say skip all of those instant approvals. Don't get the credit card. Don't take the 10% discount. It's only a one-time thing. If you have poor credit, there are ways to get credit cards, but you're paying almost 26% on average, 26% interest. And someone with bad credit probably doesn't have the means to pay off their bills in full every month. So, a $100 purchase at the end of the year is costing them $125. Mortgage rates, because you have the collateral of the house, and if you go into default, the bank can take over your house, a lot lower. Now, interest rates on mortgages have really gone up. So these rates are probably from a week ago. They may even be slightly higher now. What I wanted to show you is the difference between what you pay and what you earn. In a savings account, the national average is 0.06%. That's like 0.5% that you're earning. So that $100 that you put in the bank at the end of the year is going to be worth like $101, maybe. If you're getting statements right now from your banks with savings accounts, take a look at the amount that you've earned this year. If it's just straight savings account, it's what they call de minimis. It's nothing. So there is this imbalance of what the banks are earning and what they're actually paying. Again, they're charging a lot because they're taking a risk, but still the difference between 0.06 and 16% is a huge range. So there's a lot of profit built into the banks. Okay, so what is the real cost of credit? If you choose to pay the minimum versus a larger amount, I'm going to show you an example here. But as I said, if you pay the minimum, at least you're maintaining your credit rating, because as long as you pay on time and you pay the minimum, your credit report does not show how much you pay each month. It just shows that you paid on time. Interest compounds. So the longer you let a balance grow, if you're only paying the minimum, the longer you just pay the minimum, the more that principal is going to grow. You can go to a creditcard.com. There are calculators, there are other calculators, but this one is fairly common that show how your balance can grow if you only pay the minimum. So this is an example. If you look at your credit card statement, which I hope you do, if you're getting it online, it's really easy to skip. I totally understand that. But take a look and read the fine print. This is a late payment warning. So if you pay late, meaning if it's due on the 1st and you pay on the 2nd, it's a $35 fee. And many credit card companies now will charge a penalty APR. APR is your annual percentage rate. And they raise that rate to pretty much the highest legally that they can charge. In this particular case, it's almost 29. It is 29%. And that interest rate will stay indefinitely. I think American Express says it stays for 6 months, but a lot of companies will keep it indefinitely. So if you pay late once, I would recommend, if it's out of the ordinary, but there was an exception this month, call them up and fight it. Get them to reverse it, because you do not want this penalty APR, because even if you pay at the end of the month in full, if you miss a month, you're going to be paying almost 30% interest. So the example here is if you only pay the minimum, and this is legally required. The government has said the credit card companies must disclose how long it will take to pay your debt if you only pay the minimum. So in this case, if you only pay the minimum on a $3,000 balance, it's $90 a month. It's going to take you 11 years and you're going to pay $4,700. And that's if you never charge anything again on that card. If you boost your payment, you can't pay off the whole $3,000, but you can pay over $100 a month. You can pay it off in a lot less time. So what you need to do when you're looking at a credit card offer, first of all, if you get one in the mail, shred it. You don't want somebody stealing this and opening an account in your name. But look at the annual fee for the card. Look at the late fee. Look at the interest rate for cash advances, because if you take cash out against your credit card, they usually charge you a $10 fee plus a higher interest rate. So take a look at that. The penalty APR I've talked about. How long will the penalty interest rate apply? That can be indefinite. And what's the transaction fee for foreign transactions? You may not be traveling right now, but if you purchase anything outside of the US, they do charge that. It's usually 3% transaction fee. So that adds up. The debit card, not a credit card. It's really a good thing to have. The advantage is you have no debt, you have no monthly balance due. It's coming right out of your account, but it does not help your credit rating. It's neutral. It doesn't affect it negatively or positively. And as I said, you don't have the same consumer protection. So if your debit card is stolen, somebody can clean out your bank account. I would be very careful. I always advise people to be very careful using a debit card when you make online purchases. It's better to use something like PayPal or one of these services where you're going to a third party rather than giving your debit card number online, because it's more easily accessible to thieves. So credit cards are good for online purchases. If you're using a debit card, I would use PayPal or some other service. Okay, deconstructing credit scores and reports. What's the difference? Does it matter? And what happens if you don't have one? Your score is a number. And actually, it's not just one number. It depends on what you're borrowing for. But all of the data in your credit report feeds into what your score is. So the better your history, the better your score. And the whole idea is that it's predicting the likelihood that you're a good risk. The two major factors, and I'll show you a breakdown of this, is whether you pay on time and how much of your credit limit do you use. You should only use 30% at most of your credit limit. So if your credit limit is $9,000, you don't want to be charging more than $3,000. The reason for this is that if you're using all of your credit limit, you must need money. Therefore, you're not a good risk. Therefore, they're going to charge you a higher rate. They're going to give you a lower credit score. Under normal circumstances, if you're just using your credit card to pay normal bills, shopping, groceries, clothing, whatever you use them for, you don't want to use more than a third of the credit available. This is how it breaks down for your score. FICO, it's called Fair Isaac's company. This is sort of the gold standard of credit scores, but there are a lot of other credit scores available now through Experian, TransUnion, and Equifax. A lot of companies are coming out with their own. If you want to go to FICO, you can pay for your credit score, but you can also get it from a lot of bank statements carry your credit score now. And while these numbers that you get from other sources might not be precise, they're in the ballpark of where you are. Basically, your score is based on your credit history and the amount that you owe. If you're looking for new credit, all of a sudden you do go shopping and you open an account at the Gap and you open an account at Macy's and Victoria's Secret, the algorithm is saying, this person wants more credit, so they must be in trouble. So that might notch your credit score down. Length of history, it only counts for 15% of your score, but the older you are, the better your score is going to be just because you've had a credit card for a longer time. So if you got somebody in their 50s or 60s who pays on time, they're going to have a really good credit score. Somebody who is 21 or 22, even if they're paying on time and they're paying it off every month, they don't have the length of history, and it will take a couple of years to build up a good credit score. And you do have more than one. So you have multiple producers. There are different scores if you're buying a car, if you're buying a house, student loans. And FICO is actually coming out with a new score based on your bank account activity, meaning do you pay your rent on time? Do you pay your utilities? Do you pay for your cell phone on time? They want to monitor what bills you're paying from your bank account, and that will begin to counteract just credit card charges. A lot of people, particularly I would say under 30, 35 years old, are not using credit cards as much anymore. So how do you judge their credit worthiness? And this is one way that companies are looking at that. So what's a good score? National average is almost 700. If you want a decent rate, you want to be at least in the 700 plus. Exceptional is 800. That's really hard to get. But 740 to 799, usually it's somebody who's older, who has a good credit history, who pays on time. But this is kind of the range, and I'll show you what it really means. So this is an example about how your credit score affects your life. This is I don't know why it's $16,000 for 30-year fixed mortgage. But let's say, it's a $300,000 apartment. The rate that you will get depends on your score. And you need to know your score if you are going to be borrowing for a large purchase, because this is the kind of thing that a lender may not volunteer. They may want to get a higher interest rate because they're making more money from you. But as long as you know what your credit score is, you can negotiate. So if you have a good credit score, you can negotiate a lower interest rate and therefore a lower payment. And myfico.com has a lot of information if you want to follow up with learning more about scores. So credit reports, This is if your credit score is like a grade, your credit report is like a report card. And these are the three main companies. You can get a free credit report from each of them once a year. When you go online to look for it, they will ask you for your social security number. This is one of the few times I will tell you it's okay to put your social security number in. And you can get a really detailed look. Your credit report basically covers 7 years of financial activity. And then I would suggest getting at least one credit report if you've never checked it. My assumption is most of you have, but every 3 or 4 months, you might want to check, if nothing else, just to see if there's been identity theft, if there are things on your credit report that you don't recognize. So it's a good idea to check once every 3 or 4 months. So your credit report does not include your income. They actually, you'll smile on this one, they don't include library fines anymore. They used to, but they don't anymore. Doesn't include your bank account or debit card information, cell phone payments. This buy now, pay later, they don't report your good payments, but if you're late, they will often report it to your credit report. But your credit report will include your address and past addresses, past employers, all the credit cards that you own, student loans, any public record information, any applications for new credit. Medical debt is reported after 6 months, just because everybody knows there are such problems with getting accurate medical billing. So who sees your credit report? A lot of people can see it. Whenever you're applying for a credit card, your bank often, if you're applying for a co-op, definitely. Landlords, definitely. Some cell phone companies. In New York City, if you are applying for a job, you are no longer, this was like a couple of years ago, you're no longer required to provide a credit report unless you're going to be working at a bank or some financial services firm where you might be working with money. But other than that, if you're going to be a landscaper, if you're going to be a stock clerk, if you're going to be a teacher, if you're going to be a librarian, they cannot ask for your credit report. You should know this. And it's a good protection because it became sort of this problem. If people had credit problems, they couldn't get a job because they had a bad credit report. Improve your credit report, dispute your errors, pay on time, pay in full if you can, don't use your full credit limit. Keep old accounts open. You don't have to close them because that keeps your credit limit higher. Only apply for credit if you need it. And if your credit improves, negotiate different terms. If you are carrying a balance, you can call the companies and negotiate. What if you have no credit report and no score? Can you get an apartment? Can you get a good job? Can you get your utilities turned on? Can you borrow to buy a car? Here are some ideas. You can get a secured credit card. A lot of banks offer this, particularly credit unions. You put a certain amount of money in the bank, can be $300, $500, and the bank will give you what they call a secured credit card because it is secured by the collateral of your savings account. And if you don't pay, they have that collateral that they can use. So if you get a secured credit card, basically you can buy something not expensive, spend $50, pay it back, spend $20, pay it back. Show them that you can build good credit history. You can get a credit building loan. And this, again, you work with the bank. They can give you a small loan as long as you can prove that you are paying back. You show them that you're paying back the loan on a monthly basis. You can build a credit history that way. Your student loan definitely goes on your credit history. So if you're not paying, that's a ding. You can become an authorized user on an account. There's a difference between authorized user and joint account. If you open a joint account with somebody, you are legally responsible for all purchases in that account, whether you make them or the other person makes them. If you're an authorized user on a spouse's account, on a parent's account, on a sibling's account, they are legally responsible, but you will share in their credit history. So the person that who opens an authorized user account for you has to trust you, but that's a way to build your credit. And this is the one time I would say, if you want to try a store card or a gas station card, you can apply for a credit card because they're pretty fast and loose on who they give credit cards to. But again, use it the way you would use a secured credit card. You charge a little bit, you pay it off. You charge a little bit, you pay it off. This is how you build a credit history. And as I said, FICO is starting it, and the Experian Boost, which you may have seen advertised, is another service where they're looking at your banking activity. You link your bank account. They see that you pay your rent on time in full. You're paying for your cell phone. You're paying for your utilities. So bills that you would pay on a regular basis are reflected either through your debit card account or your checking account. And this can go towards building your credit history. Okay, I've talked a lot about this. If you are reducing credit card debt, pay at least the minimum every month and pay on time. That's religious. You got to do that. And then add whatever you can afford and pay off one card at a time. Now, you may want to pay off the card with the highest interest rate first, or if you have a card with just a couple $100, you may want to pay that off first just to get it off your plate. You can negotiate and set up a repayment plan. This is what credit counselors do. They will get in touch with the credit card company and negotiate and say, look, this person owes $10,000 and the interest rate is high. Can we freeze the account or can we reduce the amount to maybe $7,000 and this person will pay back, $50 a month? But there are ways to negotiate because the credit card companies, the banks, would rather have somebody pay off something rather than just default and walk away and have a total loss. If you feel more comfortable working with a credit counselor, go to some place that charges only a minimal fee, or New York City has good credit counseling services through the Department of Consumer Affairs. I would recommend going to the New York City resources first because that's free. Okay, this is buy now, pay later. These are interest-free, so that's a good thing. Divided over weeks, not months, mostly for online purchases. And it's very popular in Europe, just growing here, but it is a way for people to get credit without having a credit card. So this can be helpful if you can only, if you buy something that's $100, but you can only afford $25 a week in your budget, maybe you get paid weekly. The bad thing is, even though there's no interest, there could be late fees and sign-up fees, sometimes a membership fee. Late payments will often be shown on your credit report, very few consumer protections. And the one problem I see is that you got to keep track of all of this. So if you are purchasing something on Amazon and then you're purchasing something at Macy's and then you're buying something at the Gap, and you're using buy now, pay later, they all have different due dates. They all have different amounts. You're going to need a spreadsheet to keep track. I would say if you're using this at all, it would be for a fairly large purchase. Maybe you have a big event coming up you need to buy something, or maybe you need a new appliance. And it's easier for you to pay for it weekly rather than monthly. But to do multiple buy now, pay later is just going to create chaos. These are basically the ones, Klarna and Afterpay. There's also one called Affirm. And almost everything that you see online now will say, do you want to pay this off in 4 easy payments? So just be aware that's what it's all about. Okay, debt collectors. Don't ignore them. Even if you don't recognize the debt, ask for all the details. They're like scammers. They will tell you stories. They'll make you feel guilty. They will threaten you or subtly threaten you, but they have different ways to appeal to people to make a payment. When a debt collector calls, this means your debt has been sold. And they're doing it with student loans now too, but mostly credit card loans. And the debt collectors pay literally pennies on the dollar. So if it's $1,000 debt that hasn't been paid, a debt collector might buy it for $100. And so, except for their overhead, everything they make on this is profit. But this also means that you can negotiate, that you don't have to pay $1,000, that you can negotiate down to $500, $400, $300. And also check how old the debt is. Because if it's over 6 years old in New York, I think it's 6.5 years old, there's a statute of limitations. In other states, I think in Colorado, it's only 3 years. If your debt isn't paid in 3 years, it's off the books. And the debt collector must disclose how old the debt is. So ask to see details. Sometimes it might be a case of mistaken identity and it's not your debt. Sometimes it's your debt. If you get a summons, which is not as common now as it was a few years ago, definitely respond to it. If you ignore it, you automatically lose. If you don't go to court, you automatically lose. And if you're making payments, keep really good records. Send it certified mail, ask for signatures, don't pay cash. You want to make sure that you're getting credit for these payments because there are some unscrupulous debt collectors who will collect on your debt and then sell your name to somebody else and not tell them that the debt has been paid or settled. Now, if you are only on Social Security, now everybody here is working, but you may have a parent or, someone in your family who's only on disability or Social Security, that's their only income. Those sources are exempt from debt collection. And I would recommend keeping those in a separate account because you have to prove that it's separate. They can't touch your IRA, they can't touch alimony or child support. So if they threaten you, these are things that cannot be touched. Also, you're not responsible for someone else's debt. If your Aunt Sadie passes away and she's left a lot of debt, a debt collector might call you and say, well, she would have wanted this paid off. No, if your name is not on an account, you are not responsible. If you do negotiate, if it is your debt, be honest. Don't let them talk you into opening a new credit card to pay for it or borrowing money. What I will leave you with here is New York City has a really good debt collection brochure. It's online. That really outlines all of your rights and responsibilities, but make sure you have everything in writing. Trust but verify, that old saying. Okay, medical debt, I mentioned, don't put it on a credit card because if you can't pay it in 6 months, that debt will be sold. And medical debt often takes 6 months just to get straightened out. There's a company, I think it's called care.com, that offers credit cards. When you go into a doctor's office or a hospital emergency room, do not put medical debt on credit card. If you don't think you can afford it, if you don't have insurance, speak to someone at the medical office beforehand. Ask for any kind of assistance that might be available. So try to negotiate before rather than after. The worst case situation is having medical debt go to a debt collector. Scams. You have to be careful because they promise easy answers. If they want you to pay up front, some of them charge $700, $800. They often don't tell you what your rights are. If they promise to get these off your credit card bill, they can for a month or so, because if you challenge a credit card charge, they will take it off your bill until they resolve it. So it might come off your bill 1, maybe 2 months, but then it's back. So I would just stay with legitimate credit counselors. And as I said, New York City has a really good credit counseling group. Okay, so I would stay away from debt consolidators, pawn shops, title loans where they have you take a loan against your car payment, or tax refund anticipation loans. This is a good time to think about this because if you go to somebody like H&R Block or Jackson Hewitt, they often will say, we can give you your refund immediately. You don't have to wait a couple of weeks. Well, number one, the government pays their refunds a lot quicker these days. And number two, more importantly, this is a loan. So if your refund is going to be $1,000, you may only walk away with $800 because basically they're loaning you this money and then they take the tax refund when it comes in. So stay with legitimate accountants, CPAs. The AARP has free tax preparation services. I believe the library hosts some of this. So I would stay away from some of these street corner tax preparation people. Bottom line, this is it. Check your credit reports. Address errors, pay in full, pay on time, and thank you. Bye now.